The last few days have been something of a dead cat bounce. You had a very, very sharp move, which inevitably you see markets always trying to correct themselves a little bit. But I think there are concerns. It's very, very early days. But to us, I think there are three reasons why you should expect this coronavirus concerns to hit markets, probably more than you saw in SARS. And I think the first thing is that asset prices are really, really overvalued. So as we came into this year, they were always going to be vulnerable to any kind of shift in sentiment, which exactly is this. And then the second thing is social media. If you compare it to 2003, there were about 100,000 tweets per day. And now you have that amount in 1 minute. So that kind of fear, that echo chamber of fear and knowledge is a lot faster. And then the other thing is global supply chains. You know, compared to 2003, they're more complex and more global. They're very inextricably linked. So even companies that don't look like they would have direct exposure to China are feeling the impact now.
Wow, that's a very interesting thought about sort of the echo chamber of social media, the psychology that
Yes.
plays on our anxieties and our fears. So if you're an investor this morning, what should you do?
I think you have to have a cool head in this one, because the thing is, we simply don't know how this is going to pan out. We came into this year actually like emerging Asian equities and debt. And I don't think we're going to change our call. I think what we're thinking is this is a long-term strategic view. We see growth in that area over the long term. So actually, at some point, there's going to be a better entry point. But of course, you have to watch this very carefully. And the other thing is you need hedges. So you need defensive exposure. That was the case a few weeks ago, and it's certainly the case now. And one of the favorite sectors for that is real estate, because real estate tends to be a domestic asset. So it's somewhat insulated from global concerns. And then the other thing is US Treasuries. I mean, they're very expensive, but when things like this hit, and we do expect there to be repeated shocks from other places through this year, Treasuries are going to outperform.
Wow. So still a lot of uncertainty, and we've sort of talked about the market psychology of it. What about the economic hit, a real economic hit for Asia, certainly, maybe the U.S., or is it Asia, but the ripple effect through the supply chain is where it hits the U.S.?
Well, yeah, exactly, and I think that's the key point. You know, we talk a lot about the retail, the tourism, the airlines, etc., but a lot of that should bounce back once this is contained. On the other hand, if it extends to the point that it starts affecting supply chains, so companies usually have stocks for a while. If that extends into the second half of the year, it hits production. And that's where you have concerns with the global growth forecast.
We were speaking earlier, and we're just about out of time, how there are some things that get made back up. But maybe that Starbucks trip won't get made up. Maybe that trip to the movie theater won't get made up. But maybe a business trip will when those flights resume?
I think so. I think those are postponed, and then people still do it. They want to buy stuff, they'll postpone it. But actual production, that's where the concerns start to set in.